In this episode of the Construction Lending Podcast, we lean on expert Daniel Gilman from Morris and Garritano Insurance to better understand the essential coverage builder's risk insurance offers for materials and property during construction.
Who do you usually see paying for these policies?
I think it's important that the check get written by the project owner. The project owner is ultimately responsible for their project.
Do I need builder's risk and policy, before my construction loan closes, just to have it in place?
You can do some horizontal dirt work without a builder's risk. It's just dirt work. But as soon as we go vertical, including foundation work, that builder's risk policy should be placed.
Is it cheaper to get a renewal or an extension? How does that work?
Depending on the carrier, for the most part, going into like that 24-month, that's about the max you can get, and then you can start renewing or extending after that.
I'd like to welcome everybody to the Construction Lending Podcast. I'm your host, Sean Ferris with Land Grill, and today we're joined by a really exciting guest, and we've been out looking for this guy for quite some time to have him on the podcast. And being an audience out there of construction lenders and those that are in this industry, we all have like this just amazing, hunger for knowledge. And one of those areas that we're constantly seeing questions in is around insurance. And so we went out and we're bringing you today Daniel Gilman. And Daniel Gilman is with Morris and Garritano Insurance Agency, and he's a commercial risk advisor with Morris and Garritano. Welcome to the show, Daniel.
Thank you, Sean.
And with that fabulous introduction on how excited we are to have somebody talking about insurance today, I think we'll just dive in. And a couple quick questions. How long have you been with Morris and Garritano, and what do you do over there?
So I started with Morris and Garritano out of Cal Poly. So I started with Morris and Garritano in 2010-ish, and have been a commercial risk advisor with them. So to us, that's a fancy way of insurance broker, but it's a little bit different in that we really are advising our clients on their risk and then correctly transferring that risk to insurance carriers. My world is commercial insurance. So I'm predominantly working with, and I'm pretty specialized in working predominantly with contractors on the construction side. Also large property holdings, both commercial and residential, and hospitality. Okay. So all three of those worlds have a large builder's risk need.
Part of our, pre-show conversation, that we had, I was looking at, what you've put together this year already for builder risk policies that you've underwritten, and, just amazing stuff ranging from, it looks like 55 million to 2 million, just a really big, that's a big range, so I imagine that kind of looks like large multifamily, big commercial projects, all the way down to somebody building a custom home here in California.
Right. So anything from a general contractor who's a client who's building a $2 million custom home, who the homeowner said, I don't want to deal with this builder's risk thing, you deal with it for me. So then in turn, my GC client came to me for it, to a project owner building a multi-unit, 4-story multifamily, $55 million construction project.
That's awesome. Now, in the construction lending world, we hear builder's risk come up all the time. Course of construction, another name for builder's risk insurance. And I've got a pretty decent understanding. I'd say decent understanding of what builder's risk is and does, but why don't we take a step back and you let everybody know what builder's risk insurance actually is?
So I'm glad you brought up the other word for it. So builder's risk or course of construction, means the same thing. Course of construction helps you understand what we're talking about a little bit more. We're talking about insuring a structure for property damage while it's under course of construction. So taking it from even sometimes initial dirt work or horizontal through to certificate of occupancy. And then once certificate of occupancy is issued, we're switching over to a standard commercial property coverage form or a standard homeowners coverage form.
And how does, what I should say, what and who is covered? What is, when we think about it, I go out there and I, fall off some scaffolding. Is that builder's risk?
Right.
Help put that in perspective.
So we're a course of construction / builder's risk policy is referred to as a first party coverage. So the check is going to get cut to the first named insured on that policy.
Okay.
So that should be the property owner on title, which for your audience's take is typically the borrower. Should be the first named insured on the policy, with the lender then being a loss payee / mortgagee on that. So that in the event of property damage to the physical structure or materials on site awaiting installation, then that check gets cut from the carrier back to that lender and or first named insured.
Okay, so you're staying with the thread of additionally insured. You got the homeowner, the borrower, right? Followed by the lender should be always named as additionally insured, right? And then what about the general contractor, home builder on the project? Should they also be named as additionally insured?
So one thing on the additional insured is typically used more in liability language.
Mm-hmm.
In property language, in a builder's risk course of construction policy is a type of property coverage form. Lenders, loss payable, loss payee, mortgagee are the more applicable terms.
Okay.
With additional insured being very liability specific. So our first named insured should be the name on title. The owner of the property should be first named insured. A second named insured can be the general contractor as well. Because if materials get delivered on site but are still awaiting installation, does the homeowner own the roofing materials? Does the GC own the roofing materials? That nuances can sometimes be troublesome. So if I was to be building a custom home, I would be the first named insured, and I would add my GC as the second named insured. Whether they specifically asked for it or not, I would just put them on there as the second named insured. And there's no, hey, here's an extra 50. It doesn't cost any more to do that. And then the lender would be lender's loss payable, loss payee, mortgagee added onto there as well.
All right, so I'm going to repeat what I thought you heard, just to be absolutely clear. So the owner, borrower, they're the first person on there to be insured.
Correct.
The second person, you'd always recommend, who the owner has the big contract with, the general contractor, as being the second insured.
Correct.
And then having the lender listed as the loss payee or mortgagee of that particular policy.
Correct.
And the kicker on it that, everybody should be excited. There's no additional cost for them to be named like that.
Correct.
Okay. And why do we want all of them to be named on the policy? Like, why? You kind of touched on it. Why the builder should be named as a second insured to that policy?
Right.
Why should they be named? Is if do they need to be named? Is they got skin in the game because maybe they haven't been paid for something, or
the example is the windows get delivered. Mm-hmm. And the windows grow legs in the middle of the night and walk off. And depending on the contract between the homeowner and the GC, or depending on where they were in their payment schedules between the owner and the GC, and this and this and this, and who owned the windows? And if the builder, the owner, didn't own the windows, there's no coverage as if they're the only named insured on that policy. So that's why you also want the GC on there as a second named insured.
Okay.
To plug that possible gap of things growing legs in the middle of the night that and not covered.
Like we've all seen that happen. No, that's great information to know. So now we've covered, who's insured and how they should be named, on the particular policy. Let's talk about what's actually being insured, right? Is it you mentioned stored materials, which may be a surprise for some people on there. But is it pretty much anything that's improved or stored on the property?
So in the most basic sense, you can think of it as a commercial property. It's covering the same thing that a commercial property policy or homeowner's policy would be, in that physical damage. The same perils insured there are insured on the builder's risk. Additionally, there's things such as the materials on site. You can even have coverage for materials at a temporary offsite location awaiting installation. You can include coverage for materials in transit. So you can also have coverage for the trusses while they're sitting on a flatbed on their way to the site. There's extra things. What now?
I didn't mean to interrupt, but would that be like an additional part of the policy, or is that just kind of standard coverage?
A lot of builders risk policies have a sublimit in there of say $25,000 for materials in transit. But then we can easily increase it to 50, 100, 250, whatever we need for that particular project. And then for a very large project, you can have the other part. For a very large project, you can easily have a laydown yard somewhere else. So materials are coming in, laying down here, then moving over. And so you can have a very high value of items, a mile laydown yard away from your multifamily construction project.
Now, what about, I'm imagining, a single family home, we got the trusses on, it's framed out, we're starting some rough in, what types of damages or what types of events, be it the two, would be covered? Is lightning strikes the home and the whole thing burns down, is that covered?
So, I'm in California, so my number one thought is always fire.
Mm-hmm.
The second thought, depending on your location, is crime, theft,
Okay.
or damage due to something related to that. And from a claim standpoint, those are typically the two biggest things that we see. And depending on, I know we're talking mainly single family homes, but you can extrapolate down from this for very large projects, say a $25 million multifamily home. Those carriers require electronic surveillance on site to monitor for typically two things. One, monitoring for heat signatures in the property, looking for fire. Two, same system, electronic surveillance monitoring for movement in the night to then dispatch the police.
Wow.
So using that, you can see sometimes it's helpful to look at what's happening on these larger projects to then think about what our risks for a single family dwelling are. So for you to insure your multifamily large project, you have to pay for electronic surveillance for, in California, fire, theft prevention. You can extrapolate that down to what your risks are for your single family dwelling as well.
Is there anything that you would advise, say I'm a construction lender and I've been provided the builder's risk coverage, is there anything that you would want to be looking for on exemptions to the policy?
Like if there is some type of exclusion.
Exclusion. That's a great.
There's not typically one-off exclusions that get added into these. But I would be thinking more knowing those risks. So it kind of gets a little bit into underwriting too. So think about the underwriting for builder's risk, and then thinking about those risk factors for you on your loan and your borrower's ability to obtain builder's risk. It's predominantly driven by the addresses score for fire and crime. And so if those two things are high, builder's risk is going to be more difficult to obtain, more expensive to obtain, and more likely to have a claim in the end too, because if our crime and wildfire scores are higher.
No, it's, that's interesting. I'm also assuming like, hey, you're going to see some state by state differences as well.
Yes.
Okay.
And on that topic, I'm not very good in wind, hail in Missouri. So like in California, I jack up my wind, hail deductible to get credits because what do I care? Yeah. What do I care? So it's like, oh, you're going to have a 5% wind, hail deductible. I go, hey, take it to 20 because I want the extra credits for jacking up my deductible there because I live in California and majority of my projects are in California. And depending on the lender, we then have that conversation with the lender ahead of time and say, hey, I know I'm going to ask for a 20% wind hail deductible. Are you going to be okay with that? And walking them through the why of that. And the astute lenders understand, yeah, we're in California. What do we care about a wind hail deductible? No. So Missouri, not too good on builder's risk. I can't give you any good examples in Missouri right now.
Well, here, let me ask this question, almost like a backwards to what I asked before about like, hey, what's covered versus, well, what would not be covered? What are the things that would not be covered under builder's risk or course of construction?
So from a property peril standpoint, it would be the same thing that's not covered under your homeowner's policy. But it's better to think about liability to a third party. That's not covered under a builder's risk policy.
Give me an example.
So
are we talking like subcontractors and suppliers? Or are we talking about
so a lumber gets delivered to the site.
Okay.
And the forklift is moving around, and then knocks over the fence and damages the neighbor's prized tree. The builder's risk course of construction policy you have is covering your structure. It's not going to go pay for the neighbor's damage over here. That would be on the contractor, the supplier's liability program. Or if a worker on site is injured while working on site, that's a workers' comp claim. That's going to go on their employer or GC's workers' comp policy. It's not going to be covered under the course of construction policy.
Now, that's really, really helpful, to take it into the perspective of like, hey, there's additionally workers' comp, and then there's, builder's liability insurance, and, what constitutes claims underneath those two types of insurance.
Task, all that stuff, they own it. They're then making their GC responsible for carrying it out, but they still own it. And so from that regard, I think it's important that the project owner ultimately be responsible, own that placement of the policy. They could task it to their general. They could tell their general contractor, I want you to pay the premium for it, which all moves back and forth anyways, but the owner should own it.
I think kind of from the lens of the construction lender, we got all these legal instruments, but one of the most important ones is the construction loan agreement. And I think in almost 100% of the loan agreements, be it for a consumer construction loan, commercial construction loan, you name it, it is the obligation of the borrower to have a builder's risk policy, course construction policy at all times. I think we've seen some examples where the fee maybe has been rolled into a construction contract with their builder or contractor, and it's been included in the budget to be financed into the cost, or it may be something like a VA construction to perm loan where the veteran themselves cannot be responsible for any of the construction related costs, and it has to be rolled in to the construction contract. So, but at the end of the day, it's through those loan agreements, even on the VA loan, it's always the obligation of the owner borrower to have that in place. Now, thinking through timing, right? If I closed on a construction loan today and it's a vacant lot, right? Do I need builder's risk and policy, before my construction loan closes, just to have it in place? Like, do I need it that early, or, is there kind of some sort of best practice? Like, hey, your foundation's not going to walk off the job site, but once you get lumber out there, once you get stored materials, you probably are getting closer to, you better have it in place.
So taking loan funding out and then adding it back in at the end, but taking that out and thinking just more in a vacuum of a self-funded project.
Mm-hmm.
You need to have, you're best off placing a builder's risk policy as soon as the first bit of materials show up on site, including foundation work. You can do some horizontal dirt work, but without a builder's risk, it's just dirt work. But as soon as we go vertical, including foundation work, that builder's risk policy should be placed. Partly because from an underwriting perspective, that is the expectation. And as soon as you don't place it prior to construction starting, we all of a sudden have to start underwriting why you didn't place it sooner.
Ooh, interesting.
So if you get, let's say you're 2 months into construction and you go, kind of feel like I should have bought this builder's risk thing. Let's go ahead and do it. I now have to know what trades have already been performed, what's the value of the trades already performed, when were those start dates, what were those end dates, why didn't you buy it, what trades do we still have to perform? Underwriting just got much more complex, and depending on the percentage of completion, it will eliminate certain carriers. Certain carriers have certain metrics of, hey, once a project's 10% complete, I'm out. Once a construction project's 20% complete, this one's out, and so on and so on. You really are best off, and you don't get that much time credit for a 12-month policy versus a 9-month policy versus a 6-month policy. You really are best off doing it as soon as the first bit of materials show up on site.
Well, what is, you mentioned some time constraints in there. What are, kind of some benchmarking metrics? And I know you're kind of limited to California maybe in cost, but, I would think like, hey, for every $100,000 of project costs or hard costs or loan amount, expect to pay, X dollars for builders.
Right. And so in California, a typical rate is 50 cents for every $100 of coverage.
Okay.
Being California based, and then certain contractors or project owners, more even so, definitely do some stuff. Oregon, Washington, Nevada, Arizona, to have projects in multi-states, but don't have it like that. In California, it's a good rate on a low end is 50 cents for every 100.
Okay. No, that's good. And it's probably similar metrics in other states. California, it's the upside down state these days, so I'm assuming it's probably just more expensive.
Yeah, I do. Texas, I don't believe is too far off. Mm-hmm. Their risk for fire is lower. Their risk for wind hail is higher, and it kind of works out to be about the same.
What about duration? Do policy expense costs? Hey, I'm going to build the home in 6 months, 9 months, 12 months, or 18 months. Does that play into it, or is that just based
Most
on?
of the rates, we're thinking in 12-month terms. But many times a 12-month policy will cost you the same amount that a 9-month or 6-month would, just because to some degree,
It's the same.
it's the same. It's yeah, the materials out there are just a little bit less and all that stuff, but to some degree, if I, as a builder's risk underwriter, are going to charge you, Sean, $5,000, I kind of want $5,000, regardless of you doing it in 9 months or 12. My risk is that it's going to go down in that time period. But taking it out of custom home, there are certain projects like a commercial tenant build out you can do in 3 months, and there's no questions asked that you're going to be able to fulfill your commercial tenant build out in 3 months. So you can do policies of any time period with a maximum of 2 years.
Okay.
Now, the longest policy you can get is a 24-month policy.
Yeah, with what we just went through with the pandemic and watching the supply chain and projects drag out a little bit more, what happens as my project starts to go over 12 months? Is it like, hey, I got to pay for a renewal and that's an additional cost, same cost, or is it cheaper to get a renewal or an extension? How does that work?
So depending on the carrier, for the most part, going into like that 24-month, that's about the max you can get. And then you can start renewing or extending after that. It's the same thing in the shorter policy terms. Depending on the carrier, you either would say you have a 12-month policy. Depending on the carrier, then you hit your 12 months, project's not done yet. It would either renew for another 12 months and you can cancel pro rata if you only needed it for 3 months.
Mm-hmm.
Or sometimes, depending on the carrier, you'll do extensions of X period of time. Hey, I'm done. I still need 3 more months. Okay, we'll extend it for 3 more months. Hey, I still need another month. Okay, we'll extend it for another 3 months, cancel back. There's different renewal and extension mechanisms that can be done. For many carriers, you get about 2 extensions. And then if you need an extension after that, a lot of times you have to find a new carrier.
Now, if I'm out looking for builder's risk, I'm building my home or, asking a contractor to do it, and I've somehow been tasked with, Sean, you got to go out and find it. Of course, I'm going to call you, right? But, for those that don't have the luxury of living in California today, what kind of questions should they be asking a broker, or somebody out there? Like, what should they be doing that would be helpful for them in making a decision on builder's risk?
I think the first thing they should do, if they're a homeowner, is contact their homeowner's agent, their homeowner's carrier. If they're a commercial property owner, contacting their commercial insurance broker, and feeling confidence in that broker's knowledge base about that policy. And then the other person they can talk to is their GC, because even if their GC isn't directly placing it, their GC is going to have a working knowledge of their clientele in their geographical spaces, ability to easily or with difficulty procure a builder's risk policy. And then after that, it'd probably be going over to their lender and saying, I don't know where to go right now. I'm not getting good answers. That'd be kind of the order of engagement I personally would do.
Anything as far as questions, like if I call you up and say, hey, I need $1 million, I loved your recommendation, saying, hey, I want to negotiate this down and this higher. Are there any things conversationally that, the buyer should be aware of, or questions they should ask?
I think the first question would be, hey, do you do very much builder's risk policies?
Great question.
Like, hey, do you do these? Yay, nay? I mean, that'd be the best thing to ask. No, I don't. Oh, okay. Who do I need to call then? Before you ask too many, like, hey, I'm building a $1 million custom home over here, blah, 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 blah. You just went into Q&A session and you skipped over the first thing, which is, do you do very many of these? Yes, proceed. No. Do you have someone else in your office that does? No. Okay, looks like you need to go look somewhere else. That'd be the first thing I would ask. And then, so then it's, do you do very much builder's risk? The answer is positive. It's yes. Okay. My next question would be an open-ended question, which is, what do I need to know about these policies? And hopefully you get value in learning from that open-ended question so that then you build confidence to substantiate their first response, which was, yes, I do these builder's risk policies.
Well, what about, coverage amount, right? And I'm going to ask this perspective instead of being from, the owner out there shopping for policy. I'd like to ask it from the perspective of the lender, right? And if I'm a construction lender and I want to tell my borrower that you need to have builder's risk and you're obligated under your construction loan agreement, and they turn it in, it's for $500,000 and they got $1 million construction loan, right? I want to set good expectations. So if they're going to go out and spend the time and pay the money to do this, that they know, who needs to be insured, we know which property needs to be insured, but we also should probably be telling them what the amount is, right? So it may have, maybe a $2 million, custom home that's being built with $1 million construction loan on it, right? So do I get it insured for the construction loan amount? Do I get it insured for the total replacement cost, the hard cost? Like, what are we talking about in being able to convey how much should be insured?
So at minimum, we want to be insuring the total hard cost for the project, regardless of the borrowing amount. The insured limit, the insured value should be total construction hard cost. And it's difficult at minimum. And it's difficult to get a policy that's not total hard cost, because many times we have to provide a construction cost breakdown for underwriting in the numbers they got to check. On smaller scale projects, you can sometimes get away with saying, I need a $121,000 builder's risk policy, and the system is set up that it's easier to move it through than to go substantiate it with a cost breakdown. But it should be at minimum hard cost. And then in addition, it's best to be insuring for a soft cost that you would expect to reincur if the building were to go down. So total soft costs, I don't think we should be insuring for total soft costs, because if I paid my architect $35,000 to draw my home and the building burns down after 90% completion, I don't have to pay my architect another $35,000 to redraw the drawings. I do have to have them redo a few things because codes changed, this changed, and my boss, my wife, came up with a new idea. We probably are going to change something on the plans anyways. But either way, the architect, which wouldn't be insurable, the architect would have to redraw. So the permits would have to be resubmitted. There are soft costs that you would reincur, but at a lesser scale than your full soft costs that you had incurred to date.
And you're not going to have to pay for, the land acquisition. You're not going to have to pay for financing costs unless you need a loan extension. But hopefully you work that out.
Right.
Deal with the lender. Profit overhead and supervision technically is hard costs. Indirect but hard costs. Permits, those should probably stay in there. What about the amount it costs to have the whole thing demo, scraped up, cleaned up to get started?
That would be included in the builder's risk already. Yeah,
Okay.
That'd be an extension in there.
So it'd be that plus the hard costs. Okay, so I would So then I would be able to advise like, hey, let's take a look at a copy of your budget. And we want to make sure you're at a minimum insured for the total hard costs of construction and any reoccurring costs that would reoccur that are soft costs. So
Yes.
you're building, you got a $1.8 million set of hard costs, 200 of soft costs, 200,000 of soft costs. You should be fine at the 1.8 mark, even though the loan amount may be for $1 million.
Right. It would be difficult to get, if you're building a $1.5 million home, it would be difficult to get a builder's risk policy for only $1 million anyways. It would be difficult to get that through underwriting with everything above board.
Now let's kind of flash forward a little bit in a hypothetical for you. We go out, I'm building my $2 million home. I got my builder's risk policy for 1.8. I mean, we're ready to get that certificate of occupancy and move in, and the whole thing, there's something happens and fire, and the thing burns down, right? Now we'll get replenished for the 1.8, right? The lender gets made whole on any disbursements, any undispersed amounts to the builder that they had money in. So, pretty much that 1.8 is going to be spoken for. But a $1.8 million build probably took me 18 months to do. And over that 18-month period of time, we're seeing inflation and, pretty crazy numbers historically now over the last few years. It's no longer 1.8. It's going to be 2.1 to build. What happens with that difference? Is that covered or is that not covered?
You would need to come up with some more money.
So hopefully we've appreciated during that same period of time, and maybe I get a second or something to cover that.
You hopefully you're still working your day job.
Still working my day job. Okay, fingers crossed. That's really, really helpful. No, I really
can I go back to the soft cost discussion really quick?
Sure.
I bring up you should be insuring for a percentage of total soft costs to account for that soft cost that you would reincur. But I also talk about sometimes you look at a very large scale project and then bring it down. So taking a very large scale project that has a project owner, multiple limited liability partners who are very sophisticated equity funds with an advisory firm creating tranches for investors, and then another hard money lender. And all of those people have difficulty figuring out, who all are specialized in construction, have difficulty figuring out the amount of soft costs that would be reincurred. And so I bring that in as a cautionary tale that there's no perfect way to do that. And you need to be careful that you don't get stuck because there's more unknowns with that. On the hard cost side, the only unknown is material cost increasing, but we're going to have to rebuild the building. Soft cost, there's more opinions in there. There's more subjectivity. There's more room for error. There's more room to get bogged down unless everybody's on the same page that we understand this is imperfect. So using that as an example, all of those parties have to kind of come to an understanding, and they say, all right, we're going to insure soft costs for 3.7. We're going to insure hard cost at 18 million, and we're going to insure soft cost for 3.7. How'd you guys land at that number? We all stared at the spreadsheet and we put some discount factors on this and this, and we looked back to this project and we decided that's what we're comfortable with, and that's what we're going to insure for. So I just bring that up in the sense that don't get bogged down in staying in that because it's going to be wrong anyways.
Well, if there is a loss, going back to my example, and say we were insured for what did we say? 1.8, and say we upped it for an additional $100,000 worth of soft costs. So we're now insured for 1.9 million total.
Right. Yep.
And that house burns down, and say the cost of construction now hard costs, it's 2.1 million to build the home, but I really didn't need that additional, 100,000 in soft costs that I got insurance for. Is that going to be withheld if I don't need to utilize it? Like, can you almost use it as a?
It's typically two different limits. You typically have a hard cost limit and a soft cost limit.
So even though my cost of construction went up to 1.2, if I don't use those soft costs somehow, they're going to go unutilized.
Correct.
Oh, wow. Wow. That's a really important differentiator. It kind of changes the way I would strategize about what I would require.
And typically, whether you see it or not, there's a rate, the rate for hard cost is lower than the rate for soft cost. The soft cost rate's actually a little bit higher.
Now, is there,
whether you know that or not?
Now, is there a, when I put on my risk management hat and I start, going through all the what if scenarios, I know construction lenders are really savvy over certain things. Like, you don't recommend a builder to a borrower. You don't want to take on that lender liability of, helping them make that decision. Is it the same way with builder's risk when you call out an amount, right? So is there a difference between saying, hey, I want you to go get builder's risk for 1.8 versus letting the owner decide, hey, it needs to be 1.8 because it needs to, I'm obligated for X% of soft costs plus hard costs. Is there any liability with telling them the amount and being wrong?
It needs to be the insurance requirements need to state total construction hard cost.
No, yeah, I mean, here, let me take a step back. So if I'm a construction lender and I'm advising the owner borrower to go purchase a policy, are there any concerns over me saying, hey, it needs to be 100% of hard costs and 30% of your soft costs on your budget? That's what we require. Is there a difference in that situation, the way I worded it there, versus saying, hey, you need specific coverage of 1.8 million in hard costs and telling them you need an additional 75,000 in soft costs? Do I want to take the step of telling them the amount and risk being wrong if something was ever to happen? Or do I just say, hey, 100% of hard costs and X% of soft costs?
100% of hard cost, X of soft cost, or a derivative of that. I liked when you broke that out of, you need to be insuring for 100% of hard costs. You should be insuring for a portion of soft costs. That one's hard to get into. You got to be a very sophisticated construction lender to in your specific area to know what values would be reincurred on the soft cost. But no, you shouldn't be advising on a specific limit. Nor do I advise on a specific limit. I pull up the construction cost breakdown and I say, it says 1.834. That's what we're going to insure it for. No, it's not really going to cost that. It's probably going to do 1.6. Let's insure it for 1.6. And I go, I can't. I literally can't. It's going to be 1.83456 because that's what the cost breakdown says. Send me a new cost breakdown and I'll take that. But it's got to be cost breakdown, from the general.
So in every situation, when an insurer is going to issue a policy, they're going to ask for a copy of the hard costs and soft costs for the project before they issue the policy.
Yes, an exception to that can be on some smaller scale projects. Some smaller scale projects, that is not a requirement for underwriting. For larger scale projects, yes. And it's got what that break even, tipping point is. I don't have a perfect answer for that. But on larger projects, it's got to match perfectly between the limit you're requesting on the application to the limit that's on the cost breakdown, to the limit that shows up on the policy, to the evidence that goes to the lender, are all going to be the exact same number, all built off of that construction cost breakdown number. I mean, I've literally had an underwriter come back and say, and it's like talking about a difference of $15. Hey, construction cost breakdown and the application don't match. And I'm like, what are you talking about? They don't match. And I go pull it up and, I rounded my initial application that I did for an indication 3 months out, and I didn't update it to be the exact number down to the penny. But that's what an underwriter wants. They want it to match.
No, that's great to know. Do you see that happen often where they don't match?
I see it happen often from they don't match from the standpoint that we've talked about it a little bit, talking about construction costs changing, it takes you 24 months to build. Well, it takes you 24 months to plan sometimes. And so what you think it is going to cost you at the very beginning to then middle road on the plans, then final plans, then the bid, then we get to the costs are changing all the way up until we start, and then they still keep changing. So they are typically different just from the standpoint that they're evolving. They're not, none of them were incorrect. They were correct at that snapshot in time. So we're always evolving and updating the builder's risk number, sometimes right up until the policy gets bound.
You mentioned something really interesting in there about, cost changing before. My mind's going, cost change during, like, are there any notification requirements to changes in the scope, changes in the cost? Like, is there, I haven't heard anything there, but there's no obligations to say, hey, we cut out a bedroom because costs went up, or like, hey, the borrower's writing checks, we're way over budget. What is the...
Not typically, no. There's typically no like policyholder warranties that go into the policy. I think the key part in that, coming back to it, is that you correctly represented the project when you applied for, the policy. Just like you can take that into the lending world, that you correctly represented yourself when you applied for the loan. You correctly represented yourself when you applied for the policy. And yeah, some things can materially change, but as long as you represented yourself correctly at that time, you're in good standing.
Yeah, I always want to make sure that the property can get completed, and lenders not getting stuck with a mess on their hands. But you mentioned this minimum amount or minimum recommendation, 100% of hard cost, a percentage of soft cost. Could the lender take it a step further and say, hey, we want, we're averaging 4% inflation every year. In construction, it's a little bit higher. In California, it's a little bit higher because regulatory changes will be different next year, what you got to put in for the outlets, right? Could you say, hey, we want you insured for 105% of hard costs?
I don't think we can get a policy for that.
Dang it, that would be a great idea. When you go to rebuild it, you're covered.
Right. I don't think you need a policy for it. As we talk about lender requirements, in tangent to that, the lender should also be requiring proof of general liability from the general contractor and proof of workers' comp for the general contractor, or proof that if it's 100% paper GC, proof that they don't have any employees. But thinking about if I was building my own home, you need to make sure that you have proof of general liability from your general and workers' comp from your general. And the lender should be equally vested and equally concerned about getting those proofs as well.
That's a great transition here to my next segment. What are the amounts, right? General liability, workers' comp, much more common, much more understood. What are the amounts that a lender should look for? Because they'll make a renovation loan for an ADU or, bathroom remodel. It's going to be a whole lot different, dealing with a renovation contractor than, somebody building $1 million custom home. How should a lender approach the amount, the liability insurance amount for a general contractor?
So an industry standard on a minimum is $1 million policy. It's pretty difficult to get a commercial policy for less than $1 million per occurrence liability limit. Can you get a $500,000 per occurrence general liability policy? Yes. I won't give it to you, but you can get it. I think you might save 10%. So you just gave up, you shrunk your limit in half and you only saved about 10%. And you need to start thinking through the type of contractor that needs / wants to save just this little micro. It's not a good business decision. Probably not a contractor that you want on your job site. So at minimum, the GC needs to have $1 million per occurrence, naming the project owner as additional insured for liability. And that GC needs to in turn require all subs on the policy, on the project also have $1 million. The lender can't really get into that part too much, but in the insurance requirements, it's completely fine and normal that I see insurance requirements come over saying builder's risk X, proof of contractor's liability, naming borrower as additional insured with $1 million limit, proof of workers' comp. Can't be additional insured under workers' comp, just proof of workers' comp, but it would be acceptable for a lender to say, I want proof that the builder / general contractor has $1 million general liability, naming the borrower as additional insured. Because if something goes wrong there, the owner's ability to make due on their loan payments is now called into question.
Yeah, no, that's a great thing. I'm going to give you a kind of a situation here. You've got some sort of specialty contractor that, is doing, so let's just say some renovation work on a home, and they've got $250,000, say $300,000 worth of coverage. And say the lender's just used to looking at $1 million coverages. What should they be concerned with when they see 300,000? Say it's only the remodel is only a $50,000 remodel. Would you sit there and weigh it against the project cost, or do you sit there and say, hey, regardless of the project size, these are the things that can happen, and we want you insured up to $1 million standard?
The types of carriers, the types of carriers that you have to engage, and the types of insurance agents that you have to engage to obtain a lower level policy, less than $1 million, aren't ideal. So from a pure risk management, like, is 300,000 limit enough when the project's only a $5,000 bathroom remodel? Probably, yeah. But I would argue that trade contractor didn't make a good decision in how they bought their insurance, and then extrapolate that out to what other non-perfect, well, nothing's perfect, but what other poor business decisions is that contractor making, which would lead to a higher risk for the job.
Oh, that's really interesting, that it should be reflective on, character and the way they operate, more so than, hey, is it enough of a policy to even
right? If you're working, you kind of have to work hard to get your limit to be under that standard of $1 million. You got to work pretty hard to get it to 100, get it down lower to the 250. It's fair to say you're starting to cut some corners, you're shortcutting. What else are you doing that with?
What if it's garage door installer? Is that the kind of the same thing for, somebody that's just really specialized? Hey man, our average install is 20 grand. We don't need a big policy. It's just not customary. Or is it customary across all the trades?
It's pretty customary. I mean, it's $1 million.
In every state? Would you say in every state, or at least in California?
At least in California. Okay. But you're also not saving very much premium by going with a lower limit. And so that's where I get into it's a on a larger scale, it's a poor decision to cut your limit by 1/3 to save 10%. It's just, to cut it by 1/3 to save 1/10 isn't a good move. So it should be $1 million.
would you tell lenders to, hey, stand your ground, $1 million minimum, no exceptions, end of
Yes.
story?
Yes.
Okay, no, that's good to know. Now, you started to go into the workers' comp, and I wanted to kind of bring that up last year. What's the right amount of workers' comp somebody should have?
So workers' comp is predominantly a statutory, benefit. You see that limit on there of $1 million. That's actually, so a workers' comp policy, and I'm going to answer it for California because we're special. And so a workers' comp policy is technically workers' comp / employer's liability, not employment practices liability. That's something different, but employer's liability. And in the great state of California, if an employee is injured, the system is set up that 99.9% of the time, the workers' comp portion of that policy pays under the statutory limits. And it's whatever the statutory limits are. So if I'm injured and I can't ever work again, and me and my family are going to get the $3 million to pay for my exorbitant medical bills, and the $2 million for my ongoing medical bills, and the $3 million for wages for the rest of my lifetime, that's just going to pay. There's no limit on that. The employer's liability portion has a limit to it. And those are unique, I'll leave it at that word, unique claims that tag into the employer's liability portion.
So, and usually workers' comp is based on, your trailing 12 months payroll or some percentage of that the state dictates, right?
Your workers' comp is based off of, if you're running a April 1st through April 1st policy, you're paying a rate times your payroll for that policy period. So from April to April, it's your payroll per 100 times a rate to get to the premium.
And do all states, to your knowledge, I'll put you on the spot here, and you just guess or let me know. Tell us you're guessing, but do all states require workers' comp?
There's one state that recently I know didn't. I think Texas doesn't require it. The majority of states require workers' comp. I think 46 states, it's a private-based system, and there's 4, maybe 5 monopolistic states where the workers' comp has to be bought through that state's monopolistic fund.
Wow, that's really interesting. Now for the tough question, right? How do you, if I'm a home builder, right? I'm not covered under, I'm personally, if I'm the owner builder, I'm probably not covered under the workers' comp policy.
No, it couldn't even, it'd be difficult for you to get covered under your workers' comp policy, even if you wanted to. If you're 100% Sean owns Sean's building, you can't even really get covered anyways.
Yeah. So, say on that, but I sub everything out. I got a framing company, I'm from a more project management perspective type of general contractor. And I don't have employees. How should a construction lender approach verifying that they don't have employees?
So using California's example, you would go to the Contractor State License Board website, which one you should be anyways, to verify that they have an active contractor's license. And on there, you would see this license holder has proven exemption from workers' comp requirements. And so the contractor on their annual license renewal has to prove that they don't have employees. And so then that would show up on the CSLB's website. And so as a lender or a builder, then the Contractor State License Board is doing that vetting for you.
Oh, that's great. And, I don't think well, actually, now that I think about it, seeing the little indicator on the California licenses, I've seen that, but that's not the case in every state, right?
My hunch is most states have that ability to track that.
Would you, and I'm trying to think of, the situations where they don't. If a builder was asked to sign hey, I'm going to attest that, I don't have employees, is that another safe, somebody could always lie, you know, is that a safe way to confirm whether or not they should have, hey, I don't need workers' comp because I'm exempt, and here's my signed form that says I should be exempt?
Well, and that's how they prove, using California. That's how they prove to the contractor state license board they don't have any employees. They sign that attestation itself, anyways.
Okay, so it'd be safe to say, hey, first check their license, and if they don't have their license, make them sign an attestation form, or maybe you don't necessarily need to get it notarized. I don't think the notarization would provide any additional benefit in a court of law, but that's always kind of good to know. And then if you see employees running around the job site, that's a whole different. Or employees emailing you,
right,
contract stuff, and it's like, well, what does Bob over here do if he's
right,
got your same email address and says he's your project manager?
right.
Oh no, that's super helpful. Now, what we're kind of nearing the end here of the podcast, but kind of general question: what kind of advice would you give? If a construction lender was sitting on your doorstep asking you a bunch of questions like I am today, any kind of advice that you would give to them, in how they should approach, procuring, asking for building policies, around whether it's builder's risk, general liability, workers' comp, any advice that you'd give them on, like, hey, be a stickler about this, don't be a stickler, what kind of advice would you give them?
I thought of a different answer that's not as objective, which is learning about the owner / borrower's relationship with the general contractor. Because ultimately that relationship is what is going to fulfill the contract or not. And how do you know this GC? How's it been through your planning process? Have you worked with this general before? Did you get references for this general? And that's important too, even if the general has a great reputation locally. It's important to know how that working relationship has been. And if it's been strained through pre-construction, it's going to probably break during actual construction. So that's a very interesting component, is what's your relationship with the GC?
Oh, that's great advice. Any pitfalls that you've seen, any mistakes that owners or lenders or builders have made in construction that lead to some sort of catastrophic event? Anything?
I think of when somebody is picked their GC because they got multiple bids and that GC was the lowest bid, which is okay, but they haven't actually engaged a working relationship with that general to date. Everything's just been here, there. Oh, I don't know. He's going to start on this date, and we exchanged a couple emails. You need to have a working relationship with your GC so that the two of you can, as partners, because you're still the owner of the thing, fulfill that project. And so as a pitfall, it's just understanding or trying to gauge, have the GC and the owner / borrower engaged in a working relationship, or when they start digging a hole to lay the foundation, is that the first time those people are going to meet face to face and start figuring out how to work together?
No, that's absolutely great. Absolutely great. Now, I can't say how much, how valuable this is. And I know people are listening to this podcast, they may know 90% of it, but I'm sure that there's definite nuggets that I've, even myself have gotten to pick up on that are super valuable. And thank you so much for,
You got it.
for sharing all this information. We're at the end, and we're going to do a little rapid fire session that we do at the end of every podcast. And the first rapid fire question, if you're ready.
Well, hold on, let me answer one thing really quick.
Go for it.
For fun, I thought, should I go back and watch these things on YouTube and listen to all these and be prepared for how Sean does it? And I went, no, it's going to be more fun just to shoot from the cuff. So this is fun. I didn't know this was part of it. So yeah, I'm ready.
Your question's got to be somewhat customized because you're not a construction lender. And
Okay.
usually we have construction lenders, but we really expanded the guests to, you know, kind of get outside of our comfort zone and learn more about, you know, even the other things that we're touching, you know, construction lenders in the industry. And, you know, that this is one of those great examples. So your question is going to be a little bit different, Daniel.
Yeah.
But first question, you know, any book or movie that you've recently watched that you enjoyed that you would recommend to somebody else?
Book book wise, I'm reading Meditations by Marcus Aurelius. So Stoic philosophy. So that'll be my recommendation.
First one to ever recommend that one. That's never had that one. What about a movie?
What did we recently watch? It's not a recent watch. Well, I'll give you two. One, Maverick is a great movie. My son loves it. I'll give you another one that you probably haven't gotten recently, Legends of the Fall.
Ooh, that's always a fun
I think everybody needs to have watched Legends of the Fall.
It's really, really well made. And we just recently rewatched Maverick, and I think I enjoyed it more the second time than I did the first time.
I'm probably like 14 times deep, maybe over 20.
Yeah, I think each time I lean over to my wife and I go, "How old do you think Tom Cruise is? You know, when he made this, because he looks damn good for being that much older than I. I mean, look like we could be the same age now.
Yeah,
guy doesn't age." All right, next question. Is there a recent product that you've discovered that you really, really enjoy? And I'll give you an example. You know, I've said it before, I'm a diehard for the Ember mug. Probably one of the best creations and inventions I've ever seen.
So my product plug would be the Chirp foam roller.
Chirp foam, I don't know.
So the Chirp foam roller, it's this 12-inch wheel that you then can foam roll your back, and you literally lay on it, and you roll it up and down your spine, and it cracks your back and self massages your back, and you find knots in your back you didn't even know existed.
All right, I'm writing that one down.
And I think I got it for Christmas, and I went to Denver on a ski trip, and I literally landed, and I told my brother, "Oh my gosh, I forgot to pack my Chirp wheel." I think I've used it daily since Christmas.
Is it better than one of those like vibrating, you know, massage?
I haven't done that. I stick to my Chirp wheel.
Yeah, that thing is, those are actually intense. I mean, you could hurt somebody with one of those, but they work great. But I got to check out the Chirp. Have you, or would you ever build your own home?
I would build my own home. I'd hire a general contractor to do it. But I would build a custom home.
Oh, that's great. Now,
why would I hire a GC and not self-perform it? Because trade contractors like working for generals, and and GC's number one thing they have is a Rolodex of relationships. And that GC has stronger, better, long-term relationships than I can ever try to create with every single trade that walks onto the job. And I want to have one relationship, and that's with my GC, and they manage all other relationships. And I'm confident that my project will come out better by just having a good GC.
That's great advice. Great advice. All right, we're nearing the end. What would be your go-to? So now this is one I had to customize. What should be your go-to question? You kind of already answered this one, but what should be your go-to question when shopping for an insurance broker?
The first one would be asking if they have expertise in that industry or line of coverage. Is this something you work with frequently? So using myself as an example, if a trucking company called me and their first question was, do you do insurance? I'd say yes. That didn't tell them very much. Do you do insurance for trucking fleet? Do you regularly place insurance for trucking fleets between 20 and 50 power units? I'd say no. No, I do construction. I don't know trucking. They shouldn't use, that trucking company should not use me to place their trucking insurance because I don't know how to do it. So that would be the first thing is, how regularly do you work with this product and or this industry?
That's great advice. Great advice. This is all just, golden nuggets here. Now, if somebody wanted to get in touch with you, there's a construction lender in California goes, God, I gotta meet Daniel and want to learn more about Morris and Garritano. What's the best way for them to get in touch with you?
So you can find our website, Morris, and then Garritano, GARRITANO.com. And then you'd be able to find me under the team on there, and all my contact info would be on there.
Fantastic. Daniel, absolutely love this podcast. I'm sure our audience is going to love it even more. Thank you so much for attending today. And, we hope to have you back soon.
You got it. Thank you, Sean.
Have a great day.
This podcast is intended for educational and informational purposes only and does not replace independent professional judgment. Land Gorilla Inc. makes no representations, warranties, or promises for and disclaims any express or implied warranties related to content. Before acting on any information, you should consider the appropriateness of the information as it pertains to your unique business needs.